there's an old adage in real estate: location, location, location. So, you know, in film, distribution, 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 quite critical. So this, again, is very sort of surface level stuff, but it's good backdrop for the rest of the conversation about financing. So it's going to be very likely, it will be the driver of whether the film succeeds or fails. It's just a matter of what form it comes in. And I laid out some of the larger categories. So you've got major studios and mini majors. Majors, obviously, everybody knows the big six, right? You've got Warner Brothers, Sony, Universal, Paramount, MGM, and Disney. Fox and Disney. So, and I shouldn't put MGM in the majors. They're probably more categorized as a mini major at the moment. Lionsgate is a mini major, but on the cusp of probably being considered a major. And then you've got some of these other groups that maybe are called independent distributors, but are studio based and have their own autonomous capital. There are companies that you might see when you're watching films like Legendary, maybe an Alcon, or, you know, there are a few companies that have, and New Regency, that have their own capital, but also have major studio relationships. So they sometimes hold back some of their rights and sell, for example, the international rights, but they have a home, so they know their product's going to have an outlet in the U.S. Again, so these, if you know, historically, the old Hollywood was really sort of a few companies kind of very much controlling the market. And you see, even though in the U.S., the majors, for example, control this 80 to 90% of domestic box office. When you look globally now, what I was saying earlier, you see the trend line is that they're actually in the minority globally. So the international markets have really sort of started to outpace them. They're still quite important, though. I mean, what tends to happen, even with, and maybe more so with, you know, simultaneous U.S. and international theatrical release, the sort of marketing dollars, those P&A commitments and resources become very, very important, because if an international distributor can look at that as a campaign that is usable in their market, they get leverage off of that when they release in their own market. So independents. The other things that independents are typically known for is being very good at these what are called platform releases. So you have a solid independent movie, you want to get a theatrical distribution. Instead of thinking that you have to compete with the major studios for a 2,000, 3,000, 4,000 screen release, which is really kind of where the upper end of that market is now. You know, an independent distributor can sometimes, you know, find a better fit for the film, because a lot of films just aren't made for that as an initial venue. So you'll see a lot of the more successful and award-nominated movies are often platform releases, where they start at anywhere from 50 or 100 to several hundred screens, and then based, if they're succeeding and word of mouth is working in the right way. And by the way, I have a new term, I call it word of thumb, because I think social media is really driving that as opposed to people actually talking about it these days. But you'll see that they'll increase the commitment and go wider with the movie as it succeeds. So the independents tend to be much more nimble and capable, and even the cinema relationships they have are better suited for that in a lot of cases as well. So one of the drawbacks of the independents is they often don't have the same type of resources for marketing. So, you know, they rely on being very capable of getting close with the filmmaker, trying to understand the movie, convince the filmmaker they're the right party to handle it, but they sometimes are challenged to really, you know, if it really takes off, you sometimes have a happy problem, but it's still a problem to try to chase additional marketing money that wasn't in the original plan. This happens on really successful platform releases where it started out very small and suddenly you're chasing it and trying to find money to throw after it. That's a good problem though. International distributors. So this will range. So sometimes you have parties that are more of a territorial buyer. So there's somewhat of an intermediary where they're acquiring rights to movies, but they may not directly control their own distribution channel. They have relationships in their territories, so they're very adept and those relationships drive their ability to put a value on the film, to take that risk, knowing that they're going to lay off the rights, in many cases, to numerous parties, whether it's theatrical, television, pay TV, and a lot of those markets, in the more recent times, have been driven by the pay TV values. So, like cable and these sort of things, but subscription cable. So, sometimes you get regional buyers as well. Alejandro, you're a good example.
Wow.
Yeah, they're buying for all of Latin America as opposed to one country. A lot of other times you'll have people that are very specific to one country, and culture plays a lot into that, whether it's language that becomes regional or isn't, and just other people have different relationships. So in terms of the financing side, a key term in that world is what's called a minimum guarantee. So you go to the American film market here, or to Berlin next week, and a sales agent takes your movie, and if an international distributor or buyer finds that attractive, they might make a commitment for distribution, and they will have a contract, and in that contract, if they have a minimum guarantee, what they're doing is they're agreeing that when they get delivery of the movie, there's a lot of variations in this, but generally speaking, they're bound contractually to pay an advance on those distribution receipts. So all of this is kind of transferring risk. So if you get an international buyer to put up a minimum guarantee, and they're referred to as MGs a lot, when that happens, what's effectively happening is that buyer or direct distributor internationally is then picking up a lot of the risk that in fact they're going to get it to their end user, and they're gauging competitively what that's worth to them on the marketplace. And if they make a minimum guarantee commitment, they deem that they feel comfortable, they think they're going to at least cover that by what they do with it in their own territory once they have the rights. In the international business, by and large, I would say is a cash and carry business, meaning that if you don't pay like this minimum guarantee amount, if that's what the contract says, the rights don't typically vest with you. And on the producer side, you're typically, and the sales agents are very adept at this, they're typically trying not to, they're walking a fine line because their relationship is with the buyer, and at the same time, they have legal pressures not to have the film fully in the buyer's control until they've received payment. And so all those payments then go into this sort of common collection account that's often administered by a collection agent. Okay, so digital platforms, we've talked about some of the places, but if you look at outlets like Netflix, Hulu, people are doing things on YouTube, creating channels. There's a lot of outlets that never existed before. Unfortunately for the independent producer, one of the real hard parts about that is you're often relying on what are called aggregators. So you'll see people that I guess probably call themselves, for the most part, a distributor here in the U.S., for example, or a digital distributor. And unfortunately, with things going at the moment, it seems pretty well for Netflix. They don't want to deal with an independent producer. So they rely on having these sort of supply lines through certain chosen aggregators, and those aggregators then make deals with independent producers for individual films. And unfortunately, on the revenue side, it's very challenging for the independent film, because you see the revenues getting divided up first at that level, and then when it makes it onto the digital platform, it's been divided already before it gets to the split with the distributor, and these are called distribution fees typically. Anyways, the good news is it's a double-edged sword. The good news is that digital distribution is becoming more tangible, clearly a growth sector. It presents a lot of challenges, especially for the small independent movie, the good news is, there are outlets there that didn't exist before. The bad news is, they're probably most punishing on the small independent producer, even though they're an opportunity. And second to that, if you were a larger independent producer, they call into question some of the traditional values. So we're in this moment where some of those values are declining. This new area is, growing in digital, and most people would say there's still a disconnect between the two. So some of the values that are being lost aren't fully being made up by the digital platforms. So that's a current challenge, but it's going in a good direction, I think, digitally at least. Okay, so now we're going to start to juxtapose budgets with capital. So what I've done here is I just tried to look at a little bit of the evolution of, production capital. So all of these light bars here are kind of the profile of what's available to the producer, and the darker columns are how the capital is made up. So really the old days, my early days, there were these things called, major studio negative pickups. Life was so simple. There was one distributor, a major studio. They would acquire films, distribute them globally, one distributor. And from a capital standpoint, the producer would take that contract, typically go to a bank. The bank would either lend them the entire value of that contract, and the whole production could be made without any equity. Or probably there was a little bit of equity to get it to the point where the studio was going to agree to it. So whether that was development equity that stayed in the movie, or whether that was a discount that was applied by the financier. And I'm not sure if you're familiar with discounting, but let's say you had a lot of any of these distribution contracts that you wanted to use as collateral for financing. Oftentimes, the financier will give you an advance against it, but they may not give you the full value of that contract. So they may discount it based on their assessment of what the risk may be in that contract, or in the actual, realizing the value from that contract. So even sometimes when it looks like you have, enough distribution collateral to fully fund your film, you probably should be thinking of it that I still need a little bit of equity. And that's typically the case. So, but the point of all this is to sort of go from that sort of old model, and then going back as long as, 20 to 25 years ago, you started to see, from a financing standpoint, the use of these international distribution contracts, where a producer would do just like we've been talking about. They take their movie to a film market. A sales agent helps them license it to various people globally. They take that collection of contracts, they go back to their financier, and the financiers started to evolve as well, and started to give value against those international contracts. So in this case, you've got a variety of these pre-sold contracts. It might include a US distributor, it might not. And then you've got these estimated values for the rest of the world. So I'm a sales agent, I take your movie, you come to me as a producer, and I look at, typically in those days it was generally on script and some idea of cast. I look at that and I say, well, I know my marketplace of international buyers. I think I can probably get a certain amount in each territory, and then they would give you projections on those global values. And then in practice, they would either strategically, or just because of what the market would or wouldn't do at the moment, they would go and try to license it at the film market, and they might come up with a certain level of pre-sales. So these are these minimum guarantee commitments by international distributors. But they might not get enough to fully finance the movie. So what's remaining is they have these estimated values for the unlicensed territories. So, the good news is I sold or licensed Germany, Spain, maybe Latin America, some big territories. The bad news is, for some reason the UK didn't want to make an advance commitment. So the sort of interplay between those two baskets becomes important, and there was a point where this was the introduction of kind of gap financing. I don't know if anybody's heard that term, but what that means is there was a certain level of pre-sales and maybe a certain level of equity, but the financier who was putting the debt in decided it would take a little risk, some measurement of risk against these estimated values. So it's riskier for the financier, but this started to evolve and became, you know, regular practice. When I was inside the banking world, I did a lot of these deals, and the banks all had different ways that they looked at, you know, proportions of what they would advance, and then also how they looked at individual distributors. So what you saw suddenly is that if you had a collection of these international distributors, maybe you could get more product done, but the major studios might not be buying more product. So sometimes you'd have lesser values from the US and more values internationally, and when you put that whole profile together and it gets discounted by a financier, you know, comparatively you still need maybe a little bit more equity now. And then we go forward a little bit and we look at these production incentives or soft monies. So they sort of come onto the scene. Internationally, that's been happening for a long time. If you talk to European, you know, producers, they're quite adept and quite familiar with doing a whole lot of the right front end work to get various subsidy programs, you know, either this is pre-EU, and Canada in North America has always been kind of it was the gateway to get to these co-production agreements internationally, and smart producers would do that work, set up a co-production agreement, and I financed, you know, I don't know how many dozens of movies through Canada with other countries. But the US, it didn't exist. You couldn't get a production incentive in the US. And now in the last 10 years, as I said, you see all these states here in the US that offer these benefits. And so it's gotten to the point where globally, depending on what that subsidy is, there's a way to get that monetized. Sometimes it's with a debt financier. Sometimes it's just, you know, comforts the equity that they know that they're going to get a certain level of receipts without having given up distribution rights, which is really the key to these production incentives. Because what it does, let's say I'm going, a popular one in the US is Louisiana these days. So I'm going to Louisiana and I've got my budget, I'm going to spend most of my budget in Louisiana, and I find out I can get a certain percentage of my budget that's going to qualify as a spend in Louisiana. And most of these incentive structures somehow, some way are aimed, their big goal is to get, you know, a local infrastructure of industry built, jobs, you know, people spending money, hotels, services in their local jurisdiction. So depending on how that incentive is structured, as an example in the US, sometimes it's just a rebate where you finish your movie, you typically have to get your production budget audited in terms of the actual spend. Whatever was agreed by the administrator of the program that you spent, and a lot of times that comes down to an audit, they would give you a percentage of that as a rebate. So that's sort of, for a producer, that's kind of found money. And having done all that, you haven't given up distribution in that area. So this has really been a really positive thing in general for producers, because if you look at commercially, if the market gets a little soft and it's a little harder to get the same values, you have an opportunity to still, you know, get the same production value and potentially make a movie that otherwise might not get made if it relied on something like this. So, you know, there are some banks that will fund against this. There are a number of non-bank lenders or other financiers, and then there's equity as well. And so this is much more of a recent and current sort of profile that you see regularly, but you can see what's happening is if you look at the equity component, what you need tends to be much higher in equity these days as compared to, you know, just a few years ago. And, you know, these things also tend to go through some cycles. So if you look right now at what's happening, you know, I have some interest in a couple of entities where, you know, we've put some capital together, and so whereas from 2008 during the financial crisis it was pretty bleak out there, now at least you're seeing some money, you know, coming onto the scene again. Especially, you know, you're seeing more private equity now step up, and people are, so I think there's a little bit more money out there. So from a producer standpoint, I think that should be viewed as a good thing generally. And then I just laid out some of these types of capital providers. So again, for debt, commercial banks, we talked a little bit about these gap lenders who are advancing monies against the sales estimates. And then on the other end of the spectrum, we have equity, you know, private equity. You've seen at times some equity funds get constructed. You've also seen some institutional equity, especially at the studio level, that's come in and helped finance product. And you've also seen the emergence of this darker yellow group here, which is really sort of other funds that are deliberately going in and creating kind of a hybrid capital. So they do some of what a senior debt financier might do a bank. They do some of what, and sometimes all of what, an equity fund would do, but they provide this sort of variety. So they might finance against the production incentives, and they also might finance against the estimated sales values, and they also might put some equity in. So there are a number of groups kind of playing in this area, and I think for independent producers that's a very good thing, because every film ends up, you know, having its own life, and I think what you'll find as producers is that no two look alike as projects, and the profiles of them are going to be all over the place. So the more alternatives you have to try to put the pieces together. Again, we talked about a sort of a water balloon or a puzzle. You know, it's all sort of putting these pieces together in a way that you can attract capital. So capital providers, this is a very simplistic kind of give you an idea of where they try to put themselves in terms of risk and return. Obviously the commercial banks want to be safer, so they're down here on the risk axis, and they tend not to make the same kind of returns because they're debt, and if you repay them, they're gone. They don't have any ownership in your movie, typically. You have some of these non-bank lenders that don't have the same, you know, capital supply that a commercial bank would do. They tend to require a little bit more return. Maybe they'll take a little bit more risk for doing that. Sometimes they'll ask for a very tiny piece of your upside equity, but not that often. They want to get repaid with a decent return, and they want to strive for a better return than the commercial banks. Here you've got these sort of gap or mezzanine lenders that are really sort of more active and sometimes more aggressive against the sales estimates and you know, things that aren't pre-sales like these guys like to finance. They're trying to get a higher return. They're notably taking on more risk, but they probably aren't quite into the equity realm. Again, the hybrid guys are kind of in this region. If you move over to equity, you've got private equity, which is more third-party organized private equity. Now, sometimes you'll see them take on, you know, more risk compared to the return because they've fallen in love with a project or a filmmaker. That happens for sure, an angel investor that you didn't know before you took them this project. If you don't find that, then, you know, obviously there's self-funding, which probably eliminates most producers, and there's friends and family, and obviously those are situations where they may notably take more risk just because they know you already, or it's someone who's betting on themselves. Strategic capital is generally seeking, you know, at least the same level of return, but they probably view themselves as having less risk, because if they're strategic, they're getting another profit margin somewhere, or by taking on your film, they're creating an opportunity for them somewhere else in their existing business. So this just gives you a little, you know, top view of that. All right, we won't spend a ton of time on this, but we've talked a lot about a single movie. I just wanted to give you a little schematic that starts to take that up to how a fund might operate that's bringing capital to the market. So they're doing, if you think about that, production SPE, they're just doing, you know, a series of those. They're doing, so this could be one project, a second project, another project, one producer, a different producer, could be the same producer on two projects, you know, based on relationships. But effectively, they're taking investment money, they're putting it into a structure that's managed by a fund manager. That structure then negotiates with each of the projects for capital. They're going to usually require a completion bond. They've usually either requiring or hoping to get, in all cases, some level of soft monies or production incentives. They oftentimes, if they're bringing equity, are happy to have, you know, a senior project financier, a commercial bank, or somebody who's not really competitive with them, or it could be somebody that's just co-financing with them as well, that has a similar position. The projects then, just like in a single project, are going out and negotiating with domestic distributors and often through an international sales agents to the international distributors, eventually get to the exploitation market. So just an idea to give you an idea of how that looks when you roll that up from one project to, you know, most funds like this would target to do anywhere from at least 5 to 10 projects in a year. Now, obviously, they're relying on good producers because they don't actually want to be a producer, and they don't actually want to do the hard work of owning the movie. They want to rent their money if they can and work with quality partners. So we're back to the sort of water balloon here, and you start to see how some of the pieces are interconnected.